Good evening, students. Yes, good evening, Ashwini. Uh, any doubts with respect to the previous class? We had done assessment. We had started with that. We had done return of income. We had done faceless assessment scheme. If you have any questions before we start this class, you can put it in the chat. What we are going to cover today is the balance assessment, which is 147 and some other provisions, small provisions we are going to touch upon in today's class. Okay, so let's get quickly started with it. So as I told you, last time we had done faceless assessment. We had done 143.2. We had done 142.1. So that's what we had done in the earlier class. So this was basically the notice under 143.2. We had done the summary assessment also, and audit under section 142, valuation officer, reference to the valuation officer. All that we had covered in the last class. Is that right? Now, before we start with today's class, let me tell you, in the last class, we had done here, in this case, here if you see, we had to give the draft assessment order, right? In the case of the eligible assessee, if there was variation which was prejudicial to that assessee, right? Remember, if there was variation which was prejudicial to the assessee in case of an eligible assessee, we had the draft assessment order, isn't it? So for that, we will have the reference towards now today DRP also, and we are now going to talk about the reference to the principal commissioner in the case where there is an impermissible avoidance arrangement. So, in case where the assessing officer feels that the assessee is doing a tax avoidance scheme, or the assessee has entered into a tax avoidance arrangement. So for that, he can make the reference to the principal commissioner or commissioner at any stage of the assessment or reassessment proceedings if he has sufficient material and evidence to suggest that the arrangement is an impermissible avoidance arrangement. What is impermissible avoidance arrangement? The one which is motivated by the tax benefits. The one which is motivated by the tax benefit, for which there would be the application of the GAR. So we have a clear-cut chapter on GAR under the Income Tax Act, and section 96 defines the impermissible avoidance arrangement, which means that where the main purpose is to obtain the tax benefit, and it creates certain rights or obligations which are not at the arm's length. So it is quite possible that the two persons had done a transaction, but those transactions are not at arm's length, meaning those transactions would not have been done with a person who would have been an unrelated party, or any kind of transaction which results in the abuse or misuse of the Income Tax Act, or a person has undertaken any transaction which is not having any commercial substance, which is lacking the commercial substance. So the transaction is just done on the basis of the form. There is a kind of a corporate wheel, or for that matter, there is just a form to it, and when in substance you look at it, there is no commercial substance. So the transaction is wholly motivated by tax. or the transaction is not for bona fide purposes. So if that be the case, if the transaction is wholly motivated with the tax benefit, then in that case, the assessing officer may think that this is an impermissible avoidance agreement and therefore the GAR should be applicable. If that be the case, reference in GAR cases. Reference in GAR cases. So if the assessing officer on the basis of material and evidence determine an arrangement as impermissible avoidance arrangement, then at any stage of assessment or the assessment proceedings, you can make reference to CIT or PCIT. Is that clear? Then the CIT may issue a notice to the assessee for providing an opportunity of hearing within a period of 60 days. So PCIT or CIT will provide opportunity of being heard by issuing notice to the assessee within a period of 60 days. Is that clear? So the PCIT or CIT will issue a notice to the assessee for submitting the objections and providing the opportunity of being hearing within the period of 60 days. If the assessee furnishes the objection wherein the assessee rejects or assessee objects to the proposed action, that why a reference is needed to the approving panel. We will discuss about approving panel. So where the AO is making any reference to the PCIT or CIT on the basis of the material and evidence available, the PCIT or CIT will then issue the notice to the assessee for submitting the submissions and by providing him the opportunity of being heard within a period of 60 days. Now, assessee, if he objects to the proposed action, then PCIT or CIT, if they are satisfied with the explanation of the assessee, then they can communicate the same to the AO by order in writing. So, if the PCIT or CIT, or let's write this way. If assessee objects, If SSG objects to the proposed action, then if PCIT or CIT satisfied, if PCIT or CIT satisfied with the explanation of SSE, then they may communicate the same. Communicate to the AO to an order. Is it clear? What if the PCIT or CIT is not satisfied? PCIT or CIT is not satisfied, then they can make a reference to the approving panel for declaring the arrangement as IA. Is that clear? Now, what is approving panel? Approving panel is nothing but the approving panel consists of 3 members, including a chairperson. The chairman is the person who has been a judge of High Court. The 1 member shall be IRS, not below the rank of PCCIT or CCIT. Then 1 member who shall be an academic or a research scholar having the knowledge on the direct taxes and accounts. So this is what the approving panel is. Now, approving panel is a body of 3 persons. One is, as I said, the judge of the High Court. Second is any person who has been IRS. And third is an academic or research scholar. Now, if the PCIT or CIT is not satisfied with the answers of the SSC, if he has not done the impermissible avoidance agreement, then he may refer to the approving panel for determining the arrangement as impermissible avoidance arrangement or not. So the approving panel will decide whether the particular arrangement is for the tax avoidance or not. Is that clear? Any doubts? Okay, let's proceed further then. Then if I say that then the assessing of CITA is in fact referring to the approving panel for declaring the arrangement as IA, then the approving panel also will give opportunity of being heard to the assessee. So approving panel will give opportunity of being heard to the assessee. Is that clear? So approving panel will give the opportunity of being heard to the assessee. And what will happen then? Then the approving panel can ask the assessee to furnish the documents and evidences. The approving panel can ask the assessee to bring further records. The approving panel can carry out the inquiry also, or direct the PCIT or CCIT to inquire and furnish the report. Is that clear? Then the approving panel will issue the declarations that, or will issue direction that this particular arrangement is an impermissible avoidance arrangement, and it will specify the previous year in respect of which it is declared that this is an impermissible avoidance arrangement, and this has to be declared, this has to be done within 6 months from the end of the month of receipt of reference. So approving panel has to issue directions for declaration as an IA and specifying the previous year in respect of which it is so declared within 6 months from the end of the month in which the receipt reference is received. Is that clear? So approving panel will issue directions for declaration as an IA and specify the previous years in respect of which it is declared and this will be within 6 months from the end of the month of receipt reference. Six months from the end of the month of receipt reference. Is that clear? Then accordingly, the approving panel will issue the direction for declaration as an IA and suspecting the previous year in respect of which it is so declared within 6 months from the end of the month of receipt reference. So the approving panel will issue the directions that this particular arrangement needs to be treated as an IA and specifying the previous year in respect of which it is so declared within 6 months from the end of the month of receipt of reference. Is that clear? Then approving panel has also the duty to complete all the proceedings in accordance with chapter 10A, which I told you is for GAR. Is that clear? Further, prior approval of PCCIT or PCIT or CIT is required for passing the assessment order if any tax consequences have been determined in order as per the GAR chapter. Is that clear? So if any penalties are levied to be imposed on a person who is carrying out an impermissible avoidance agreement, then the prior approval of the principal commissioner or commissioner is required for passing the assessment order. Is that clear? And all these directions are not only binding on the assessee but even on the principal commissioner or subordinates and IT authorities. Is that clear? Further, no appeal shall lie against such an order. Clear? Any doubt? Any questions? Any doubts so far? So there will be no appeal against this particular order. Clear? Is that clear? Any doubts? Okay. Any doubt? Okay. Shall we proceed then further? Shall we proceed further then? Let's start. Give me a moment just. Okay. So that was under the reference in cases of GAR. That is for the reference in case of GAR. So whenever there is going to be GAR, this is how the approving panel has to decide on the applicability of the GAR. The approving panel has to decide on the applicability of the GAR. Is that clear? So there is no appeal against this approving panel's direction, and these directions are binding on PCIT or CIT and the subordinate IT authorities. Is that clear? Any doubt? Shall we proceed further? Now, what are the time limits for completing the assessment? Let me see. Who knows what is the time limit for completing the assessment? What is the time limit? Very quickly in the chat box, you must be knowing that. What are the time limits? So time limits are given under 153.1 or 153 rather, we can say that time limits for the completion of the assessment is given under 153. 153 says that the order of assessment either under 143 or under 144, which was the best judgment assessment, the time limit for completion of assessment will be 9 months from the end of the assessment year in which the income was first assessable. So whenever your first income started, 9 months from the end of that particular assessment year and not the previous year, mind that. So 9 months from the end of the assessment year in which the income was first assessable, that is the time limit for the 143 or 144 notice. Is that clear? So I'll write it down here. Yes. Which is 9 months from the end of the relevant assessment year. 9 months from the relevant assessment year. Is that clear? Is that clear? Any doubts? Any doubt? Okay. Then with respect to the assessment, for example, it is quite possible that the original assessment proceedings are set aside by the ITAT. ITAT set aside is that it sends it back to the authority who has passed the order. So if say for example, there is somebody who has, in whose case the original assessment has been done. In whose case the original assessment has been done, right? Now, if say for example, the original assessment has been done and if this assessment is set aside by the tribunal, then the assessing officer is required to do a fresh assessment. Then the assessing officer is required to do a fresh assessment, right? Because the original assessment was set aside and cancelled. and the assessing officer is now required to pass a fresh assessment order, right? So then in that case, what is the time limit? The time limit is, in that case, the time limit is 12 months. The time limit is 12 months from the end of the financial year, 12 months from the end of the financial year in which the order of the tribunal is received by the commissioners. The order of the tribunal is received by the commissioner, or the order is passed in case of the revision proceedings by the commissioner. Is that clear? So the time limit here is 9 months from the relevant AY in case it is 143 month or 143.3 notice. But in case the original order is set aside, then in that case, if the original order is set aside, then in that case, it is 12 months from, it is 12 months from the end of financial year, from the end of the financial year in which the order, in which the tribunal order or revision order under section 263 or 264, in which the tribunal order is received, or revision order under section 263 or 264 is passed. Is that clear? So 12 months from the end of the financial year in which the tribunal order is received by the commissioner, or the revision order under section 263 or 264 is passed. Is that clear? Any doubt? In transfer pricing cases where there is transfer pricing issue, for them the time limit is, for them the additional time limit is available, which is 21 months, which is 21 months from the end of the relevant assessment year. 21 months from the relevant assessment year. That is the time limit. Is that clear? Any doubt? Any doubt? Okay. So shall we proceed further? So this is about 153. Now we are going towards the reference to the dispute resolution panel. Reference to the dispute resolution panel. Right? That's what we are going to discuss now. So when there is the order passed, which concerns the transfer pricing order, now if there is transfer pricing order which is passed, then in that case, the assessee has an option. It can go to the CITA also. It can go to the dispute resolution panel also. So either it can go to CITA or it has the option to go to the dispute resolution panel. Sorry. Now, dispute resolution panel is an alternative to the CITA, and it is much speedier option to resolve the disputes. So, in case of an eligible assessee, eligible assessee meaning what? that the person in whose case there are transfer pricing adjustments. There are transfer pricing adjustment, right? Now, in case of the eligible assessee, the eligible assessee will get the notice, will get the order under section 143.3. Now, if you remember here, what we had done in the last class, what did we discuss about the draft order? So, we were discussing that in cases where the order is passed by NFAC, then the NFAC, in case of the eligible assessee, the NFAC or in the case of the revised draft assessment order, then in respect of the eligible assessee and where there is any variation which is prejudicial to the interest of the assessee proposed in the draft assessment order or the final draft assessment order, will forward the draft assessment order. So, in cases where it's a TP case, then directly the final order was not being passed. This is what we saw under the NFAC, under the faceless scheme. It was always a draft order which was being passed, especially in the case of the eligible assessee. So the order will not be finalized and only the draft order will be passed. Is that clear? Now, this order, which is a draft order, the assessee can make the reference to the dispute resolution panel. They can make a reference to the dispute resolution panel. Now, reference to the dispute resolution panel requires that the assessee has a transfer pricing adjustment and it is a non-resident also, so, or a foreign company. So every assessee cannot go before the dispute resolution panel. Every assessee cannot go before the dispute resolution panel. Only a non-resident or a foreign company and assessee in respect of which the transfer pricing adjustments are being made, that assessee can go for the purpose of the DRP. Is that clear? That assessee only can make a reference to the DRP. Now, the assessee within 30 days. So, we have received here the draft assessment order, right? So, within 30 days therefrom, within 30 days of the receipt of the draft order, either the assessee can file his acceptance to the assessing officer regarding all the adjustments being made, or he can file the objection before the dispute resolution panel. Now, dispute resolution panel is nothing but it comprises the principal commissioners and commissioners of income tax, and it is an alternate remedy to the CIDA. Right? So, the AO has to then, based on the directions of the DRP will give the directions to the AO that this is how you should be changing, modifying the order. So the AO has to then complete the assessment on the basis of the draft order. If the assessee accepts the variation of the assessing officer, or in case there are no objections received from the assessee within the 30 days, right? Then the assessee deemed acceptance will be assumed if the assessee does not object within a period of 30 days. Correct? Is that clear? Then, as I said, based on the DRP directions received, the AO has to then finalize the assessment. The AO will have to finalize the assessment within 1 month from the end of the month in which the acceptance is received or the period of filing of objection expires. The AO has to file the order, pass the order within 1 month from the end of the month in which either the objections period expire, that 30-day window was expiring, or if the assessee has given the acceptance. Correct? And in cases where the assessee has gone to the DRP, then the AO has to complete the assessment by incorporating the DRP recommendation, and the same also will be within 1 month from the end of the month in which the direction is received by the AO. So within 1 month from the end of the month in which the direction is received by the AO, within that period, the AO shall finalize the assessment order. Clear? Now, DRP can issue the directions like, the DRP may increase the liability made by the AO. He can reduce the variations proposed in the draft order. He can confirm the additions proposed in the draft order. However, it cannot set aside, it cannot cancel the assessment made by the AO. It can reduce, it can confirm the additions, or it can enhance the addition. But it cannot set aside any proposed variation or issue any direction for further inquiry and passing of the assessment order. So the DRP will confirm the assessment, reduce the assessment, or enhance the assessment, but he cannot set aside any variation. Is that clear? Is that clear? Right? So DRP has only the power to confirm, reduce, or enhance the variation, but not that of the set aside. And in case there is difference of opinion between the members of DRP only, then it shall be decided by majority of the members. The direction issued by the DRP is going to be binding on the assessee. The direction issued by the DRP is going to be binding on the assessee. And if any direction is prejudicial to the either interest of assessee or of the interest of revenue, then an opportunity of being heard will be granted to the assessee as well as to the AO, as the case may be. The DRP has to pass the directions within 9 months from the end of the month in which the draft order is forwarded to the eligible assessee. So direction has to be issued within 9 months from the end of the month in which the draft order is forwarded to the eligible assessee. Clear? Further, the DRP route is not available in cases of assessment or reassessment order passed by the assessing officer with the approval of the PCIT in cases where there is GAR. So in GAR cases, DRP route is not going to be available. Further, we are going to witness now a faceless DRP mechanism. Is that clear? Any doubts? Any doubts? Just give me a moment. Okay. Now we are going to start with section 147, which is going to be reassessment. We are going to start with reassessment, right? Now, if you know that earlier there was altogether a different scheme of reassessment. Till now, we had very different scheme of reassessment under section 147. Now, all of that has been substituted with the new reassessment scheme. So earlier we used to have altogether different reassessment scheme, but now that has been completely substituted. So Finance Act 2021 has revamped the reassessment scheme in cases of the income escaping the assessment. So earlier we used to have section 147, 148, 149 that have been completely revamped, and new section 148A has been introduced. So now, what is reassessment? What is reassessment? The reassessment happens in cases where there is income escaping the assessment. Earlier, there was a requirement on the assessing officer to have a reason to believe that the income has escaped assessment. Now, with the new scheme, the assessing officer can reopen the assessments if he has So when can the reassessment be done? When can the reassessment be done? So if any income chargeable to tax, if any income chargeable to tax has escaped assessment, the AO, if any income chargeable to tax has escaped the assessment, the AO may assess, the AO may assess or reassess, the AO may assess or reassess the income the AO may assess or reassess the income or recompute the loss the AO may assess or reassess or recompute the loss for a particular assessment year. For the assessment year. So the AO, if he thinks that if some income chargeable to tax has escaped the assessment, then the AO may assess or reassess the income or recompute the loss or depreciation allowance or any other allowance or deduction for a particular assessment year. Is that clear? The AO may also reassess the income concerning any issue which comes to his notice subsequently. So when the AO issued the notice, at that point in time, the AO wasn't aware about some other issue also, due to which the income has escaped assessment. So when the AO issued the notice, at that point in time, only one issue was in front of AO, according to which the income has escaped assessment. Now, it is quite possible that when the assessment advances, say for example, there was a company in which the traveling allowances were disallowed because some of them were personal expenses of the director. Say for example, during the reassessment proceedings being carried out, the assessing officer finds that even the depreciation claimed is not correct. Now, whether in that case the assessing officer can reassess the depreciation allowance also, can he do that? The answer is yes. The Act says that the assessing officer may also assess or reassess the income in respect of any issue which has escaped the assessment, and such issue comes to his notice subsequently in the course of the proceedings. So even though the notice would not have been issued for a particular issue, but if the reassessment has been started on ground A, now a B ground is also taken up by the assessing officer. Is that valid? The answer to that is yes, it is valid. So assessing officer may assess any income in respect of any issue that has escaped the assessment, which comes to his notice subsequently in the course of the proceeding, even if the steps of the reassessment are not followed, or even if the requirements of the reassessment are not followed. Is that clear? So it is quite possible to reassess the income, and it's just not that the original assessment once being carried out, that's the end of it. No, that's not the case. So reassessment can be done. Any doubts? Any doubt till now? So if the reassessment is now done in respect of, say, any issue which comes to the notice of the AO subsequently also, that is also all right. So it is not that it is impermissible. Clear? Even the Act says that the AO may assess or reassess the income in respect of any issue which has escaped assessment, and such issue which comes to his notice subsequently in the course of the reassessment proceedings. Right? Now, what are the requirements of 148? Income escaping assessment. What are the requirements? So here the requirement is conducting an inquiry to obtain the information which suggests that the income has escaped assessment. So in the earlier assessment scheme, the primary requirement for the reassessment proceeding was that the assessing officer should have the reason to believe. Now, why the scheme was introduced? Because it was realized that the phrase reason to believe was denoting some arbitrary exercise and was subject to a lot of debate as to what constitutes a reasonable reasons to believe. And the AO always had to establish a nexus between having the material on hand based on which he has reopened the assessment and explaining his belief that the income has really escaped assessment. So therefore, the existing provisions of 147 were revamped with the new provisions so that all these ambiguities are removed out. Right? This particular new scheme is focusing on the information. Information that suggests income chargeable to tax has escaped assessment. So, what is the first requirement? Having the information which suggests that income chargeable to tax has escaped assessment. Income chargeable to tax has escaped assessment. So this is the first thing, that there should be that there should be the information based on which the AO is saying that there has been the income which has escaped assessment. Now, how do we collect that information? How does the AO collects that information? So, AO will conduct the inquiry. The AO will conduct the inquiry with the approval of the specified authority. We are going to talk about what is specified authority. Right? So, AO may conduct any inquiry with the approval of the specified authority to identify whether the information which has suggested that the income chargeable to tax has escaped assessment. It will provide the assessee with the opportunity of being heard, again with the prior approval of the specified authority, by serving him a show cause notice of 7 days to 30 days from the date on which the notice was issued. This show cause notice would be for the purpose of asking the assessee to show cause as to why a notice under 148 for reopening of the assessment should not be issued to you on the basis of information which we have it with us, which is suggesting that the income has escaped assessment for a relevant AY. So, assessee is issued a show cause notice to ask him why the reopening under 148 by issuing a notice under 148 should not be carried out. Right? Then the assessee will submit the reply and the AO will then consider the reply of the assessee and will decide based on the material available to the AO whether it is a fit case of issuing 148. So that is the requirement. So first, the AO has to conduct the inquiry with respect to the information which suggests that the income has escaped assessment. The AO will provide this opportunity to the assessee by issuing him a show cause notice to reply within 7 to 30 days. The AO will consider the reply of the assessee and based on the material available with the AO, including the reply of the assessee, the AO will decide whether it is a fit case of issuing 148 or not. Again, this will be with the prior approval of the specified authority. Is that clear? Is that clear? Now the AO, when it will decide that it is a fit case to issue a notice under section 148. When the AO decides that yes, 148 is required to be issued based on the information plus based on considering the reply of the assessee, then the AO will pass an order with the approval of the specified authority. AO will pass the order with the approval of the specified authority within 1 month from the end of the month in which the reply is received by the AO, or where no reply is given by the assessee, then within 1 month from the end of the month in which the time allowed to furnish the reply expires. Is that clear? So within 1 month of that, the AO will pass the order with the prior approval of the specified authority that this is a fit case for reopening the assessment. Any doubt? Okay. Now, who is a specified authority? Who is a specified authority? So, in case Who is the specified authority? In case where the 3 years or lesser than 3 years have lapsed from the end of the relevant assessment year. In case where or let's write it like this. In case where 3 years or less than 3 years in case where less than 3 years have lapsed from the end of the relevant assessment year, then the specified authority is going to be PCIT Principal Director or Commissioner, Principal Director, Commissioner or Director, which is CIT or Director of Income Tax. Is that clear? In case where more than 3 years have lapsed, from the end of the relevant assessment year, then it is going to be PCCIT or Principal Director General, or Principal Director General, or Chief Commissioner or Director General. Clear? So the specified authority with whose permission the assessment will happen is based on the number of years the reopening has happened. So in case where the 3 years or less than 3 years have lapsed from the end of the relevant assessment year, then it is going to be Principal Commissioner or Director General, or Commissioner or Director, right? Principal Director. In case where more than 3 years have lapsed from the end of the relevant assessment year, then Principal Chief Commissioner, Principal Director General, Chief Commissioner or Director General. Is that clear? Any doubt? Any doubt till now? Okay. Now, when is 148A not applicable? When is 148A not applicable? So the provisions of 148A is not applicable. First of all, what is 148A? What is 148A? 148A, what is that? So basically, 148A is in respect of this particular section, conducting inquiry, providing opportunity. So 148A is the procedure what we followed, right? The procedure which the AO has followed. So that is contained under 148A. So notice is going to be issued under 148, but before that, certain requirements are to be fulfilled by the AO under 148A, which is conducting the inquiry with respect to the information, which is suggesting that the income has escaped assessment, providing the hearing opportunity to the assessee with the approval of the specified authorities. We saw what is specified authorities, by serving upon him a notice, a show cause notice that is between 7 days and less than 30 days. Right? That why 148 should not be issued on the basis of information which is suggesting that this particular person has income chargeable to tax, which has escaped the assessment. Right? Then, based on the reply of the assessee and based on the material available on the record, the AO has to decide whether it is a fit case to issue a notice under section 148. If yes, then the AO will pass the order with the prior approval of the specified authority within 1 month from the end of the month in which the reply is received. Or where there is no reply received, then based on the PCIT or CIT's order. Sorry, CIT's order for revision. Right? Is that clear? Any doubt till now? Any questions? Any doubt? Okay. So 148A is the procedure. 148A is the procedure. Then, by following that procedure, the AO will pass the order that this is a fit case to issue the notice with the prior approval of the PCIT or director, howsoever the authority will be. And that order will be passed, as I said, within 1 month from the end of the month in which the reply is received, and when no reply is received, then within 1 month from the time which was allowed to furnish the reply when the time expires. Clear? And now when 148A will not be available or will not be applicable, when 148A will not be applicable. So let's try and understand. So your 148A is in respect of the procedure before issuing notice in section 148. Inquiry opportunity of being heard, then consider assessee's reply, consider the assessee's reply and decide and pass the order. Decide and pass the order. Clear? Within 1 month from the end of the month in which the reply is received, or if no reply is received, then 1 month from the end of the month 1 month from the end of the month in which the time to furnish reply response. Right? Now I'm saying when is 148A not applicable? So 148A is not applicable in cases where the search is initiated under section 132. Search is initiated under section 132, or books of accounts are requisitioned under 132A, or requisition of the books of accounts on or after 1421. On or after 1421. Or the AO is satisfied with the prior approval of PCIT or CIT that any money bullion, jewelry or other valuable article or other valuable article seized under search carried out under section 132 or requisition under 132A on or after 1st April 21 belongs to the assessee. So 148 is not applicable where search is initiated under 132 on or after 1421, or AO is satisfied with the prior approval of PCIT or CIT that any money, bullion, jewelry or other valuable article seized under search belongs to the assessee. Right? Or third is that the AO is satisfied with the prior approval AO is satisfied with the prior approval of PCIT or CIT that any books of accounts or documents seized under section 132 during the search in case of any other person pertains to the information related to the assessee. So the AO is satisfied with the prior approval of PCIT or CIT that any books of accounts or documents seized during search seized during search. In case of any other person, pertains to the information or pertains to information contained therein relates to the assessee. So AO in all these three cases will not conduct any inquiry nor will give any opportunity of being heard to the assessee as required under 148A. Is that clear? Any doubt? Right? So if now 148A is satisfied, then the AO has to serve a notice under section 140A. So if 140A is satisfied that the AO is of the belief that yes, it is a fit case to reopen the assessment, then the AO will serve on the assessee under section 148 a notice requiring him to furnish a return of income for that particular assessment year. So 148(1) notice which is there that asks the assessee to file a return of income in respect of that particular assessment year. So 148 notice is for the asking the assessee the return of income furnished for that particular assessment year. Is that clear? Then the assessing officer has to conduct the inquiry, provide the opportunity of being heard to the assessee, and will consider the reply of the assessee as per the procedure laid down under 148A only to decide whether or not it is a fit case for issue of notice under 148. If it is a fit case, then along with the copy of the order under 148A, the notice under 148 will go. However, this will not apply in cases of the search, in the search cases. So when can a notice be issued under 148? 148 notice is asking the assessee to furnish a return of income, right? And 148 notice can be issued only when there is an information with the assessing officer which suggests him that the income chargeable to tax has escaped the assessment for the relevant assessment year. Sorry. The assessing officer has obtained the prior approval of the specified authority to issue this kind of notice. Is that clear? Any doubts? Any doubt? Doubts? Harshad, okay, I'll give 148 B and C. Namita, reason to believe is not to be disclosed, or reason to suspect, if you remember, is not to be disclosed when we are in the search. But in the case of the reassessment, even earlier also, in the earlier reassessment scheme, the reason to believe was disclosed by the assessing officer even in the erstwhile reassessment regime. Now we do not have anything called as reason to believe. That was a thing of past. We do not have that kind of thing now. There is no reason to believe thing which is there in this particular reassessment scheme. Here, what they just ask is that the AO should be having the information which suggests him that there is the income which is escaped assessment. So therefore, if the AO has that information, then in that case, the AO will, what it will do the procedure which is prescribed in the 148A, which is it will conduct the inquiry with the prior approval, and he will give an opportunity of being heard to the assessee by showing him a show cause notice of replying within 7 to 13 days, consider the reply of the assessee, then decide by passing an order under 148A. And then it will issue a notice under section 148. 148 notice will require assessee to file the return of income, and based on that, based on the return of income, as well as the AO will, along with the return of income, will also give the order under 148A that this was a fit case for the reassessment. Is that clear? Is that clear? Now, what is the information with the assessing officer? What is the information with the assessing officer? How he would come to know? Harsh, what you have not understood in 148A B and C. B and C is the opportunity of being heard to the assessee. That's what you mean? Or are you talking about the exceptions? What exactly you are talking about? Can assessee ask for 148 documents from AO to verify whether he has satisfied the condition or not? So, Harshad, any which ways, the AO will pass the order under 148A. So, there's no question of asking. The AO is going to pass the order and you're going to receive that order while the assessment has opened in your case. Clear, Harshad? Okay. Now, as I said, what is the information? What kind of information with the assessing officer will suggest that the income chargeable to tax has escaped assessment? So, information flagged in the case of assessee in accordance with the risk management strategy formulated by CBDT. So, understand this thing that the CBDT has certain criteria which comes under the risk management strategy. Based on these criteria, they pick up certain assessment cases. So they are the criteria like high expenditure, transactions with the related party. So these kind of information get flagged. So any information flagged in the case of the assessee for the relevant assessment year in accordance with the risk management strategy formulated by CBDT. Any objection raised by the Comptroller and Auditor General of India, CAG, to the effect that the assessment in the case of assessee for the relevant assessment year has not been made in accordance with the provisions of the Act. So, what are the information which suggests that the income has escaped assessment? Any information flagged under the risk management strategy of CBDT, or any objection raised by the Comptroller and Auditor General of India to the effect that the assessment in the case of assessee for a particular assessment year has not been made in accordance with the provisions of the Act. And cases where the AO will be deemed to have information, where the search is initiated on or after 1st April. A survey is conducted under 133A, where the AO is satisfied with the prior approval of the Principal Commissioner or Commissioner that any money, bullion, jewelry or other valuable article or thing seized in case of any person belongs to the assessee. These are the deemed information. These are the deemed information, right? AO is satisfied with the prior approval of the Commissioner that any books of accounts or documents seized or requisition in case of any other person pertains to the assessee. So, same reasoning where 148A is not applicable. and which also says that it will be deemed to have that the AO has information. So the AO shall be deemed to have information which will suggest that the income chargeable to tax has escaped the assessment. Is that clear? Is that clear? So this deemed information which we discussed just now, this is in respect of the normal information, which is the risk management strategy, the red flags raised by it, right? And the second one is the objection raised by Comptroller and Auditor General. Other than that, as I said, it will be deemed to have, the AO will be deemed to have the information in respect of search, in respect of the survey conducted, in respect of the money, bullion, jewelry, or other valuable article seized in case of any other person which belongs to you, or any books of accounts seized in case of any other person which pertains to or relates to the assessee. Now, this will be for the 3 assessment years immediately preceding the relevant assessment year in which the search is initiated or books of accounts are surveyed. Clear? So, this is for the 3 assessment years immediately preceding the assessment year relevant to any previous year in which the search is initiated. Is that clear? Any doubts? Clear? Let's do one thing. Shall we take a small break before we go to the timeline under 149? Let's take a small break of 10 minutes and then we get back. Is it live? Okay. Any doubts, students, till now? Any question, any doubt till now? Just give me a moment, I think. I'm not able to see the queries. Okay, yes. So yes, there are a few queries. Let me just take it up. Hmm. 148 is required to follow in case where AO has closed the proceeding. If proceedings are going on, then he is not required to follow 148 reg. Yes, Harshad, in respect of the proceedings which had already begun before 1st of April 21, in that case, 148 is not required. So it is only after 1421, whatever the proceedings are starting, in that case, 148 is required. What is your other question? It is, can assessee ask for 148 documents from AO to verify whether he has satisfied the condition? This I already answered. Addition of this line in case of any other person, not specifically for 148A. In general, also we can be asked for documents from AO if there's a condition that AO should do this or that. Harshad, I'm not able to understand your question. There's no such condition that AO should be doing this or doing that. So whatever the conditions are, he has to pass 148 order, right? And you can clearly see whether he has obtained the approval also or not. So that is clearly there. I hope that is clear. Okay, so what we discussed so far was that issue of notice when 148A is complied with. So along with that, you have to issue the order of 148A along with the 148 notice. And notice can be issued only when there is information with the assessing officer which suggests that the income chargeable to tax has escaped assessment. And what is the information? Information is the flagged information in accordance with the risk management strategy or the objection raised by the CAG. And cases where assessing officer will be deemed to have the information is in cases of search where there is survey conducted. If the AO is satisfied with the approval of the PCID or CID that any money, bullion, jewelry belongs to the assessee, if the AO is satisfied with the approval of the CID or PCID that any books of accounts or documents seized under search pertains to the or relates to the assessee for the 3 assessment years immediately preceding the relevant assessment year in which the search is initiated or books of accounts are requisitioned or surveyed. Clear? Now, what is the time limit for notice? So, if you remember, we had done 143(2) time limit, which was 6 months, if you remember here. Right? So, if you remember here, we had done the time limits, which was, 3 months from the relevant AY. Now, what is the time limit for 148 notice? Now, time limit for 148 notice is contained in section 149. So what are the time limits? Let's try and understand. So this was for the regular assessment procedure, and for the reassessment, the time limits are given under 149. Now, what is the time limit? Let's try and understand. So 149 provides that the time limit with respect to the notice, issuance of notice under section 148 shall be, two time limits are there. One is 3 years. 3 years from the end of relevant assessment year. 3 years from the end of relevant assessment year. That's the first time limit. So 148A says that, 149 says that no notice under 148 shall be issued if 3 years have lapsed from the end of the relevant assessment year. So say for example, it is assessment year 21-22 or say 22-23, assessment year 22-23. Then for that it will be 24-25. Oh, sorry, it's 22-23, so 23-24, 24-25, and 25-26. After that, the notice reopening cannot be made. After that, the reopening cannot be made. Is that clear? Second time limit is in cases where, which is 3 years to 10 years. Between 3 years, but not more than 10 years, where the AO has in his possession, books of accounts or documents, which reveal that the income represented in the form of an asset. So income which reveals that income represented in form of an asset has escaped assessment, or let's write it this way, that the income represented in the form of the asset greater than or equal to rupees 50 lakh has escaped assessment. Is that clear? So this is what 149 gives it. So till 10 years, the reassessment can happen. So if you know, in the earlier reassessment procedure, it was 4 years. Then it was the case that if the assessee has failed to disclose the true and material facts, then the time limit was 6 years for the assessment. And in case of the foreign asset, it was 16 years. In case the assessee has foreign asset, then it was 16 years. But now, this is clearly between 3 and 10 years. This is clearly between 3 and 10 years. So earlier it used to be 4, 6, but now it is 3. After 3 years, the reassessment cannot happen, but only in cases where the AO has in the possession books of accounts or documents which reveal that income has escaped assessment, and that income is represented in asset. So there is undisclosed asset which is more than rupees 50 lakh. In those cases, it can be till 10 years time. It can be till 10 years time. Is it clear? Now, asset means what? Asset include immobile property, land and building, both, shares, securities, loans and advances, deposits in bank account, all of that is included. Is that clear? So, for 148 notice, the time limit is in 149, which is 3 years. And if there is undisclosed asset could be the land and building, securities, deposits in bank account, loans and advances. If they are exceeding rupees 50 lakh, then it could be till 10 years. For the notice under 148, notice under 148 shall be issued in a case where the relevant assessment year before 1st of April 2021. For that, no notice will be issued if the relevant assessment year is before 1/4/2021. Then no notice under 148 will be issued if the notice could not have been issued at the time because it was beyond the time limit of 149. So as I told you earlier, the time limit was 6 years. Before 1/4/2021, the time limit for reopening of assessment used to be 4 years, 6 years, right? So if the 6 years have already lapsed before 1/4/2021, if the assessment year before 1/4/2021, their time limit have lapsed, the 6-year time limit have lapsed. Now, with the amendment provision, it is 10 years. So, can notice be issued for the extended time period for the assessment years prior to 1/4/21? If their time limit of 6 years has lapsed, then the extended time limit of 10 years will not be applicable. So, notice under section 148 shall not be issued for the assessment years before 1/4/2021 if the notice could not have been issued without considering this amended provision. Without considering the amended provision. Are you understanding? So if the time limit has already lapsed, say for example, let's take an example to understand this. Say we have the notice of AY 1314, right? AY 1314 is the assessment year, and for that the time limit of 6 years would be applicable. So 1415, 1516, 1415, 1516, 1617, 1718, 1819, 1920. So the 6 years had lapsed in AY 1920. Now, can the extended time limit of 10 years will be applicable to say that AY 1314 case can be reopened? So the answer to that is no. Since the time limit of 6 years has already lapsed, so earlier 6 years time limit was applicable, right? Then in that case, it cannot be issued. It cannot be issued. So if the time limit has already lapsed without considering this amended provision, then the notice cannot be issued in that particular case. Is that clear? Are you clear with this? Further, the 149(1) time limit will not apply in a case where a notice under section 153A. Notice under section 153A. What is 153A? Assessment in case of search. So the time limit of 149 will not apply where a notice is issued in search cases or requisition cases on or before 31st March 21. So where a notice under section 153A or 153C is required to be issued in relation to search, then the time limits of 149(1) will not be applicable if that notice is required to be issued on or before 31st March 21. So time limit of 149(1) will not be applicable on that. Is that clear? Any doubt? Namita, I already answered it that 148 cannot be issued for prior year to 1421 if the time limit has already lapsed. Yes, Namita, for AY 4015 also likewise. Is that clear? Okay, let's proceed further then. Let's proceed further. No further doubts. So as I said that 149 time limit which is there is 3 years. Otherwise it is 10 years in case there is undisclosed asset above rupees 50 lakhs. Right? And 148 notice will not be issued in case if the assessment year was before 1st April 21 and if the time limit of 6 years had already expired. Further, it will not apply where a notice under 153A or 153C is required to be issued in relation to a search initiated on or before 31st day of March 21. Is that clear? Any doubts? Okay. So, in these cases, where the information with the AO suggests that the income has escaped assessment, in that case, the relevant assessment year will be what? In that case, the relevant assessment year will be the assessment year for which the information is flagged in the system in accordance with the risk management strategy or for which the CAG has raised the objection. So what is the relevant assessment year? From where do you have to compute the time limit? So it is from the relevant assessment year. But what is the relevant assessment year? The relevant assessment year is that the year in which the information is flagged in the system of the CBD, it is flagged in the system of the income tax department. And in cases where it is where the AO is having the deemed to be, where the AO is deemed to have the information, then the relevant assessment year means the 3 years immediately preceding the assessment year in which the search is initiated. In which the search is initiated. And for that, the search should be initiated on or after 1/4/21. Is that clear? So where the information is there with the AO which suggests that the income is escaped assessment, then the relevant assessment year is the year in which the information is flagged or the objection is received by CAG. Clear? And in other cases where the search is conducted or where the survey is conducted, where the AO is satisfied that any money, bullion or valuable article belongs to the assessee or any books of accounts pertain to the assessee, then the AO will be deemed to have the information then the AO will deem to have the information for the 3 assessment years preceding the relevant assessment year in which the search is initiated. Is that clear? Clear? Namita, 149 time limit is with respect to the issuance of the notice. 153 is with respect to completing the assessment proceedings. We'll be going towards that. We'll be going towards that. But are we clear about this reassessment scheme? So, again summarizing, this is very, very important that the AO should have the information which suggests that the income has escaped assessment. In certain cases, AO will be deemed to have the information, which is the search, survey, money belonging to the assessee, money or bullion or valuable article, or any books of accounts belonging to the assessee or relate to the assessee. Right? Then if the AO is having the information which suggests that the income has escaped assessment, then any information flagged or any final objection raised by CAG that the assessment has not been made as per the provisions of the Act, that is the information, right? And in both these cases, notice is to be issued for the AY for which income has escaped assessment, along with the order under section 148A. What will be the order under 148A? Conducting the inquiry, providing opportunity of being heard to the assessee. Based on the response, based on the material available on record, the AO will decide whether it is a fit case for reassessment. And approval will be required of the PCIT. In cases where the AO is deemed to have the information, then 148A is not necessary. AO is deemed to have the information in cases where the search is initiated or the assessing officer is of the belief that the money, bullion, jewelry belongs to the assessee or any books of accounts belong to the assessee. In those cases, the 148A is not necessary. Is that clear? And if the AO is deemed to have the information, then it will be deemed to have the information that the income has, suggesting that the income has escaped assessment for relevant 3 AYs preceding the relevant AY. Is that clear? So this is how the 148 works. And what is the time limit? 3 years. And if AO is in the possession of books of accounts or other documents representing the evidence which reveal that the undisclosed asset is there, which has escaped assessment amounting to 50 lakh or more, in that cases, it will be 10 years. Is that clear? Clear? Any doubt? Yes, Namita, based on the conditions. Any other doubt? Okay. No, Namita, it has to be the 6 years only, because that's what the Act says, that the time limit specified in the under the provision of clause B of subsection 1 as before the amendment, which was 6 years and not 4 years. Clear, Namita? Okay. Let's do a small illustration from your module only. So, you have to give me the answers now. You have to give me the answers. Information flagged in the system for AY 16, 17. For AY 16, 17. AY 17, 18. 18, 19, 19, 20 and 20, 21. Correct? Then your question is, can notice be issued on or after 1/4/2021? You need to give me the answers quickly. Oh, the question is not visible. I'm so sorry. I think there was some technical glitch. So this is a question for you. Can notice be issued? Quickly. What is the answer? Very quickly tell me. very quickly. Yes, Priya, correct. Okay, let's discuss it. So, in the first case, which is AY 1617, the time limit of 3 years, if you apply, it is expiring on 31st March 20. So 3 years have already lapsed. With respect to 1718, again 31st March 21, 3 years would be lapsing. So even that cannot be issued. With respect to 1819, the 3 years time limit lapse on 31st March 22. So in that case, yes, the notice can be issued. Similar for 1920 and 2021. Is that clear? Is that clear? If, say, for example, it was a case where search is initiated during previous year 21-22. Say, for example, if the search is initiated, so for these two it is no and this is yes. If, say, for example, search is initiated, if the search is initiated during previous year 21-22, then AO is deemed to have the information suggesting income has escaped assessment for 3 AYs immediately preceding the relevant AY. Relevant AY is 21-22, right? Previous year is 21-22. AY is 22-23. So relevant AY is 22-23 plus 3 years prior. In which case it will be 21-22, 2021 and 1920. So therefore, in that case, notice can be issued for these AYs. Notice can be issued for these AYs since 3 years have not lapsed from the end of the relevant assessment year. Notice can be issued for AY 21-22, 2021 and 1920. Is that clear? Is that clear? Any doubts? Any doubt? Clear? Okay. Now, in respect of search and survey also, the earlier we used to have 153A, 153C, right? But now the same relating to the assessment in case of search and survey will also be governed by the 148A and 148. So even in search cases, 148 is going to be applicable. Earlier it used to be under 153A and 153C. So for now, the search cases will be governed by the amended provision of 148. And as you know, for the search cases, so this is, I'm specifically talking about the search. Earlier, we used to have 153A and 153C, which is no more going to be there. Secondly, it is going to be governed by 148. 148A is not required in search cases. So in search cases, as we observed, 148A is not required. If it is a case of survey, yes, 148 is required. So survey 148 is required, but for search, it is not. So earlier in 153A, the AO was authorized to issue notices to the assessee in case of a person for whom the search was done under 132 for a period of 6 AYs, immediately preceding the AY in which search was conducted. Now this provision will not be there. This 153A is now not present, right? And now in respect of the search cases also, the reassessment proceedings can be initiated for 3 assessment years, preceding the relevant assessment year in which the search is conducted. So for the search cases also, 3 years plus the relevant assessment year. Is that clear? Is that clear? Any doubt? Any doubt? Namita, it is deemed for those 3 years because it is that this particular 3 years assessment can be opened in the case of search. Is that clear? Clear, Namita? So that the previous 3 years also data can be opened. Clear, Namita? Clear? Any doubt? So this was with respect to the assessment procedure for 147. Also, one more thing with respect to the search, what I currently told you is the 149 time limit. 149 time limit which is going to be there will not apply. So 149.1 time limit not applicable in case of search, initiated on or before 31st March 21, where notice was issued under section 153A or 153C. Because 149 time limit was not applicable before 31st March 21 in case of search. So therefore, in search cases, 149 time limit will not be applicable because, as I said earlier, in 153A, up to 6 years, the search could have been opened. So therefore, 149.1 time limit will not be applicable in search cases if the search was initiated on or before 31st March 21. Clear? So reopening is subject to the time limits under 149, which is what we discussed. Clear? Now, we will be moving towards the exception to the time limit of 149. We will be moving towards the exception to the time limit of 149. Now, in case of 149, there is a time limit of 3 years, right? There's a time limit of 3 years. Now, there is section 150. There is section 150 of the Income Tax Act, which is exception to the time limit of 149. And what does it say? Section 150 says, section 151 says that in cases, section 150 subsection 1 says that the restriction of the time limit under 149 is not going to be applicable where notice is issued under 148 for making the assessment to give effect to any finding or direction in an order passed by any authority during the appeal, reference or revision or by a court in any proceeding, then 149(1) is not applicable. What do you understand by this? That in case the notice is issued, say for example, the High Court passes an order which is not in line with what assessee has done. Now, to give effect to the order, say for example, the notice is issued under section 148 for making the reassessment. Now, say for example, the High Court has passed the order. High Court has passed the order as on, say, today, in say December 2021. Now, can the notice be issued under section 148 for the earlier assessment years to give effect to the High Court order? So, Act says that the restriction of time limit under 149(1) will not be applicable where a notice is issued under section 148 for making the reassessment to give effect to any finding or direction in any order passed by any authority or any court. So 151, subsection 150, subsection 1 is basically to give effect to the orders of the High Court, tribunal or any court without applicability of the time limit of 149. So 149 time limits will not be applicable in where the notices are issued to give effect to the orders of the tribunal, appellate authority or CIT appeal or High Court or Supreme Court. Is that clear? So therefore, this must relate, the notice should be to give effect to the order of the court or the CIT appeal or ITAP. Clear? However, there is an exception to the exception. 150 subsection 2 is exception to 150 subsection 1. Meaning 150 subsection 2 restores time limit of 149. So 150 subsection 2 is an exception to 150 subsection 1. 150 subsection 1 says that 149 time limit will not be applicable where notices are issued to give effect to the order of the tribunal or High Court or CIT appeal. So 151 shall not apply where the reassessment proceedings would have been barred by time, would have been limited by time. So the reassessment proceedings, if they would have been barred by the time, so therefore 150 subsection 1 says that 149 shall not apply where the reassessments proceedings would have been barred by time. At the time when the order of appeal or revision was passed. Right? 150 subsection 2 says that 150 subsection 2 says that in cases where any assessment or reassessment relates to an assessment year in respect of which the assessment cannot have been made at the time when the order, which was the subject matter of appeal, revision or reference, was made on account of the expiry of the time limit at that point of time itself. So 152 is exception to 150 subsection 1. Are you understanding that? So 150 subsection 2 is an exception to 150 subsection 1, and it says that the provisions of subsection 1 will not be applicable. The provisions of subsection 1 will not apply where the reassessment proceedings would have been barred by time when the order, which was the subject matter of appeal, was passed. So if for that year, for a particular assessment year, the reassessment would have become time barred. Would have become time barred at the time when the appeal order, say for example, was passed. Then 150 subsection 1 cannot be invoked. Is that clear? So 150 subsection 1 is saying that orders of the High Court appeal, CIT appeal or tribunal can be given effect, and for that 149 time limit will not be applicable. But if as on the date of passing the order, the assessment would have become time barred itself, then 150 subsection 1 will not apply. So what does it mean? What does it mean that if it is not time barred as of today, then to give effect to the order, we will not apply the time limit of 149 to issue the notice. But if it has already become time barred, then we cannot use 150 subsection 1. So that is what basically is 150 subsection 1 and 150 subsection 2. Is that clear? Is that clear? Any doubt? Namita, it is in 148. Namita, 148 is just the procedure. 3 years time limit is for 148, not 148A. I hope you are clear, Namita. Is that clear? Any doubt? Any doubt? Okay, shall we proceed further? So for 150 subsection 1 and 150 subsection 2, are you clear about it? Let me give you an example. Say for example, there is assessment year 2-3. Say for example, the assessment year is 2-3. Right? Now for that, for assessment year 2-3, say for example, the High Court has passed the order. The High Court has passed the order for AY 3-4. The High Court has passed the order for AY 3-4. And the assessee's assessment is reopened for, say, assessment year 2002-2003. Now, with respect to AY 2-3, no proceeding is pending, right? And the High Court order is for AY 3-4. So whether AY 2-3 order can be reopened for under 147? Can the AO reopen AY 2-3 order where the High Court order is pertaining to AY 3-4? So understand one thing very clearly. Now, if the time limit for AY 2-3, even if I take it say 6 years, it would be 2009. It would be 2009, right? Then the time limit has already expired. The High Court order was in respect of AY 3-4, which would have been, say, as on today. So therefore, if the time limit has already expired, then 149, under 149, then 150 subsection 1 cannot apply for that year. Because 150 subsection 1 is to give effect to the orders made by the High Court or by the appellate authority for the particular year without any time limit. And if the time limit has already expired for a particular year, then in that year, the 150 subsection 1 will not be applicable. Is that clear? Is that clear? Okay. Let's proceed further then. Namita, to give effect to the High Court order, if, say, for example, High Court has given the adverse decision, so to give effect to that. But if the time limit has already expired, then in that case, it cannot be given effect to the earlier AYs. So say, for example, if today the High Court has passed the order and if the time limit has not expired, then 149 will not apply with respect to that year. But if for certain years, the time limit has already expired. So say, for example, today High Court gives an adverse decision, say in 2021. So can all the assessments by virtue of 150 subsection 1 says that time limit of 149 will not be applicable to give effect to the High Court orders or to give effect to any court order. Now, if that be the case, can 1975's case, can it be reopened? The answer is no, it cannot be reopened. If that authority is given by 150 subsection 1 to the AO, he will reopen all the earlier years order and make the adverse adjustment. Right? So that is why we have a restriction contained under 150 subsection 2. Clear, Namita? What do you mean by if we combine 150? I didn't understand your question, Namita. Okay, let's proceed further. Again, the 147 assessment is faceless, that is contained in 151A. So it is going to be the faceless assessment only. Now, understand few more things, that the income escaping assessment, at what rate that income would be taxed, as on today's rate when it is assessed or as on the rate when that income had been earned. So section 152 says that in case of any assessment or reassessment, the income escaping assessment would be chargeable to tax at the rate applicable to the respective years. So it will not be taxed at the today's income tax rate, but at the rate in which it was earned. Is that clear? Also, if the assessment is reopened under 147, then the assessee has an option to claim that 147 be dropped if he shows that he had been assessed on an amount. If he has been assessed on an amount not lesser than what he would be rightly liable for, even if the income alleged to have escaped assessment had been taken into account. So, if, say, for example, the assessee demonstrates that he has already been taxed at the rate or on the amount which would be very similar, even if the AO is saying that this income has escaped assessment, and even if he considers that income, so the amount already assessed would not be lower than that. So assessee has already paid the taxes at higher rates or at the higher amounts. Or he can show that the assessment has been properly made, then he can ask the AO to drop the proceedings under 147. But he can avail this benefit only if he had not challenged the original assessment either by way of appeal or revision petition. Is that clear? Now, time limit for the completion of reassessment. For 143, I already told you the time limit. For 147, by when the reassessment proceeding should be completed. So, time limit for the notice is under 149. But time limit for completion of assessment is under 153 subsection 2, which is 12 months, which is 12 months from the end of financial year in which notice is served. So say for example, let's take an example. We have AY 1819, right? The notice can be issued till 1920, 2021 and 2122, right? Is that right? So it can be by 31st March 22. Say for example, my notice under section 148 is issued. Now the assessment has to be completed by 12 months from the end of the financial year. 12 months from the end of the financial year in which notices was served. So if it was served by 31st March 22, then it has to be done by 31st March 23. Assessment, or let's write reassessment. Are we clear? Is that clear? Again, say for example, if the assessment has been set aside by the ITAT or by CIT under the revision proceedings, then in that case, it will be 12 months if the fresh assessment has to be made. Say for example, if the assessment goes before CIT, or sorry, before ITAT or before the CIT under the revision proceeding, then if it is set aside by ITAT or under the revision proceeding, then if the fresh assessment has to be made, then the time limit is 12 months from the end of the financial year in which the order of tribunal is received or the order of revision order of under 263 or 264 is passed. Is that clear? Where it is a TP case, then instead of 12 months, we have here 24 months for TP. So we have, instead of 12 months, we have 24 months for the TP case. Is that clear? 24 months from the end of the financial year in which the notice is served. So in this case, in this example, it will be, if it is a TP case, then 31st March 24. Are we clear? Are we clear? Right? Is that clear? Any doubt? Namita, I didn't give any example on 150 subsection 2. I have not written, I was just telling you verbally only. Any other doubt? Okay. Now we are moving towards the rectification. So we are moving towards the rectification of mistake under section 154. So if, say for example, there is any mistake apparent from record, there is a mistake apparent from record, then the income tax officer may amend any order passed by it. So any assessment order can be amended. Any assessment order can be amended. Intimation under section 143(1) can also be amended. TDS or TCS intimations can also be amended. What is the meaning of mistake apparent from record? What do we mean by that? For example, there is very glaring mistake which is there, for which you do not need to review the order. The glaring mistake which is there on the face of the order. For example, if I have treated the non-agricultural income as the agricultural income. So one mistake which is very obvious mistake, that mistake can be rectified under 154. If, say for example, the assessing officer has passed the wrong order, then it cannot be rectified. If there is some glaring mistake which is popping up, say for example, he has levied wrong interest under 234A, which is very glaring, that kind of mistakes can be rectified under 154. But however, say for example, if the assessing officer has passed the order, which the successor assessing officer is there. So one assessing officer has passed the order, but the successor assessing officer is there who has taken up the case now. That if he feels that, okay, I could have taken this adjustment in this way, that is a change of opinion. Change of opinion cannot be the basis for the rectification of mistake. So it has to be a glaring, obvious mistake which is self-evident. Mistake which is to be discovered by a long-drawn process of reasoning or examination or by arguing different points where there may be two opinions cannot be said to be a mistake apparent from the record. So what is mistake apparent from the record is the glaring or obvious mistakes. Is that clear? With respect to the Supreme Court decision, say for example, the assessing officer has taken a view, but now the Supreme Court has interpreted it in a different way. So if the assessing officer has not taken that into consideration, that could constitute a mistake apparent from record. So interpretation of law by the Supreme Court, subsequent interpretation of law by the Supreme Court could constitute error apparent from record. Retrospective amendment of law. Say, for example, the assessing officer passed the order today, but there is a retrospective amendment in the law. That is also possible to be covered under rectification. That is also possible with the rectification of order. Is that clear? So, and retrospective amendment. These can be covered. Now, the amendment can be directly done by the assessing officer if he finds it, or even the assessee can bring to his notice, or even the TDS, TCS, in case of TDS, TCS, the deductor or collector can bring to his notice. So, in case of these mistakes, the assessee also can bring to the notice, or it could be suo moto by the assessing officer also. But if there is any amendment, if there is any rectification which has the effect of enhancing the assessment or reducing the refund of the assessee or deductor or collector, then the opportunity of being heard will be given to the assessee. Then an opportunity of being heard will be given to the assessee. Here, what is applicable is the doctrine of partial merger. Now, what is the doctrine of partial merger? There are two doctrines, doctrine of full merger and doctrine of partial merger. Now, what does this mean? Under doctrine of full merger, the order gets subsumed with the other authority's order totally, or it is also called doctrine of total merger. Other one is doctrine of partial merger. Now, doctrine of partial merger, total merger is applicable only in one case, which is section 264. Section 264 is the revision by the principal commissioner or commissioner of income tax. So, under doctrine of total merger, if the order has gone towards, say, before CITA, but for this issue, C, I am making a rectification or revision application under section 264 or rectification under section 154 for C issue. Now, as per the doctrine of the total merger, the PCIT has no power to revise the order under section 264 if the order is subject to an appeal to the appellate tribunal or CIT, whatever. Even if the subject matter of appeal is issue B and issue A. Because here the entire order has submerged with the other authority's order. But in case, so for this order, 264 will not be applicable as doctrine of total merger. But with respect to the doctrine of partial merger, the assessing officer can rectify the mistake other than the one which are subject matter of any appeal, reference or revision. So, where the matter has been considered issue A and issue B, then for issue C, rectification is possible. For issue A and issue B, rectification is not possible because they are subject matter of appeal. So for 154, issue C will be taken, but for 264, issue C will not be taken because here it is doctrine of partial merger. This also holds good for section 263 revision also. Is that clear? So, what is doctrine of total merger? The doctrine of is subsumed with the other authority's author. And there can be only one order. That is the doctrine of total merger. So, in the total merger, it will be, even if C issue is not taken up, still it will be not taken up for 264 because doctrine of total merger is operating for 264. Is that clear? But in the case of partial merger, only the issues which are taken up in the appellate level, only that will not be considered for 154 or 263. Is that clear? Any doubt? Namita 149(1) time limit is not applicable in case of search where it has been initiated before 31st March 21. I didn't say that it's not applicable at all. If the search was initiated prior to 31st March 21, then the earlier provisions of 153A and 153C will be applicable and not 149(1). Namita, 24 months TP timeline which is there, it is there for assessment and not for revision order. For revision order, there is a constant timeline and which is not provided in 153. Namita, I didn't get your question. If the between two orders gap is 4 years, and how will it be merged? Namita, it is not merged. This is a doctrine which says that there can only be one order. So the order of the lower authority merges with the order of the higher authority. So it is not a merger, but it is just that it is, this particular doctrine says that only one order shall survive and the other order is subsumed under the higher authority's order. That's what the total merger doctrine is. Is that clear? Clear, Namita? Okay. Let's proceed further then. So under 154, the AO will make the rectification order, right? And if there is any mistake which is rectified, which has the effect of enhancing the liability or reducing the refund, then opportunity of being heard will be given to the assessee. If, say, for example, the liability is reduced, if, say, for example, the tax liability is reduced or the refund is increased, then the AO shall make the refund to the assessee or to the deductor or collector. Is that clear? What is the time limit for rectification? The time limit for rectification is 4 years from the end of the financial year. It is 4 years from the end of the financial year in which order was passed. So 4 years from the end of the financial year in which the order was passed. And if the application is made by the assessee or by deductor or by collector, then the income tax authority has to pass an order within 6 months from the end of the month in which application is received by it. So time limit is generally 4 years, and where application by assessee or deductor or collector, then 6 months from the month in which application was received. Is that clear? Is that clear? So if it is a suo motu rectification, then it is 4 years from the end of the financial year in which the order is passed, and where the application is made by the assessee, then 6 months from the end of the month in which the application is received. Clear? Any doubt? If say for example, there is any assessment made, or assessment order is passed, which is required to be amended with respect to the specific provisions which are listed under section 155. For them, the time limit of 4 years would not be from the end of the year in which the order was passed, but will be from the dates or from the year specified under 155. What are the specific cases under 155 for which time limit of 4 years from the end of the financial year in which order was passed is not applicable? 4 years time limit is applicable, but it will not be reckoned from the date from the year, financial year in which order was passed, but from the different period. And what are the cases? Rectification of order of assessment of partners, assessment order of partner due to disallowance of the remuneration in the hands of the firm. Remember, we had done that if the remuneration is disallowed in the hands of the firm, there will be consequent reduction in the income of the partners. So if the order of partner is rectified, so if the partner is assessed under 28(5), right, and the firm gets the deduction, but if the disallowance is made in the hands of the firm, then there will be consequent adjustment in the income of the partners, right? Is that correct? So if the assessment is made of the firm and if there is a disallowance, then in the assessment order of the partner, if there is a rectification, then in that case, the time limit of 4 years will be from the end of the financial year in which the final order was passed in the case of firm. So 4 years time limit will not be from the year of passing the order, but 4 years time limit will be from the order passed in the case of the firm. Is that clear? With respect to rectification of the AOP's members order due to the enhancement or reduction of income of AOP, right? Then in that case, 4 years will be from the end of the financial year in which the order of the AOP was passed. Clear? With respect to the rectification due to disallowance of excess loss or depreciation allowed, due to disallowance of excess loss or depreciation allowed. So losses incurred in 1 year is carried forward and claimed in the subsequent year, right? However, say for example, the year in which loss is incurred. Now that year is subject to the reassessment. And say for example, the excessive loss is disallowed. Say for example, the year in which loss was incurred, then in that year, say for example, the excessive loss is allowed or it is disallowed. Now, in the following years also, there will be the impact, because in the earlier year, if the loss is adjusted and it is carried forward to next year, so in the next year also, there has to be the adjustment, right? So in that case, the 4 years time limit will be reckoned from the end of the financial year in which the reopening order under 147 was passed. Clear? Is that clear? Where, for example, there is rectification on account of capital gains which are not charged to tax by virtue of exemption under 47.4 or 47.5. 47.4, 47.5 was transfer of capital asset to wholly owned subsidiary and vice versa. Right? But if the conditions are violated, then there was a capital gain under 47A. Do you remember capital gain class? So if there is rectification on account of that, then 4 years will be reckoned from the previous year in which the capital asset was converted into stock in trade, or the parent company ceases to hold the subsidiary company. Remember, 47.4, 47.5 transfer of capital asset to wholly owned subsidiary or vice versa was exempted. But if there is transfer of capital asset, conversion of capital asset to stock in trade, or where the wholly owned subsidiary ceases to be wholly owned subsidiary, then the exemption was denied and the capital gain was taxed under 47A. So if there is rectification on account of that, then 4 years will be from the year in which the capital asset was converted or the wholly owned subsidiary ceases to be a wholly owned subsidiary. Is that clear? If there is rectification to give effect to the TDS or TCS not deducted, if there is a rectification on account of TDS, TCS not deducted. So if, say for example, the TDS, TCS credit has not been given due to the TDS, TCS certificates not being furnished along with return of income. So I told you the deductor has to furnish certificates to the deductee in form 16, 16A, 16B. But if the deductee is not having the certificate and the TDS credit is not given, and later on the TDS certificates are furnished, then in that case, if the rectification order is passed, then there will be 4 years. The 4 years time limit will be applicable from the end of the year in which TDS, TCS certificates are produced. Is that clear? Is that clear? Then rectification for giving effect to the foreign tax credit. For that also, it will be 4 years from the end of the year in which the assessee files the application after the dispute is settled in the foreign country. So it is possible that the assessee has not received the credit because there was some dispute in the other country. And now that dispute has settled. So in that case, it will be 4 years from the end of the year in which the dispute got settled. The assessee files the application for that. Is that clear? Similarly, in cases where there is revision of full value of consideration. Remember, if the assessee disputes the stamp duty value and it gets revised, then the period of 4 years will be from the end of the previous year in which the order revising the value was passed in the appeal. With respect to recomputation of capital gain on account of reduction of any compensation in the compulsory acquisition, then 4 years time limit will be from the end of the previous year in which the order reducing the compensation was passed by the court. Is that clear? Any doubts? Namita, these are certain specific cases where it cannot be reckoned from the 4 years of passing the order. Namita, 4-year expiry is also covered under 149 1B as 4 years is between 3 to 10 years. So why you said only 6 years expiry is covered? Namita, I didn't get your question. I didn't get your question exactly. Okay. 149 1B is Namita 3 years, right? Last one point before we close the session is notice of demand. So if there is tax liability, penalty, interest, then the AO will serve upon the assessee a notice of demand. With respect to the intimation, under 143(1), no notice of demand is sent. That intimation itself is deemed to be the notice of demand. No separate notice of demand is sent. So in intimation also, if there is a liability shown while processing your return, that itself is the notice of demand. It is deemed to be the notice of demand. No separate notice of demand is given. Similarly, it is there for TDS, TCS statements also. So notice of demand will be served to the assessee in respect of the tax liability arising. Right? Is that clear? Notice of demand under 156 will be served on the assessee. And with respect to the losses, where during the assessment, it is established that there is a loss which is to be carried forward and set off under the head capital gains, under the head business, speculation loss, loss from owning an activity of maintaining of race horses, then AO shall notify the assessee by an order the amount of loss computed by him. That is called the intimation of loss under section 157. Also now rectification and all these intimation are going to be faceless, just like the assessment only. Correct? Is that clear? With respect to the specified securities and sweat equity shares of specified securities of startup and sweat equity shares. So if you remember, we had done that in TDS also. The tax on specified securities or given to the employees of the startup is to be paid in the year of exercising the option. Usually, in case of this, in case of the specified securities or sweat equity shares, the tax is required to be paid at the time of the exercising the option. However, for the employees of the startup, the perquisite is taxable in the year earlier of expiry of 48 months from the end of the relevant assessment year, or when the employee ceases to be the employee, or in the year in which the securities are sold, whatever is earlier. In such cases, tax or the interest on income included in the notice of demand shall be payable by the assessee within 14 days after these earlier of the period, whatever I discussed so far. Is that clear? Any doubt? Namita, in 149 earlier, there was 16 years, 6 years, 4 years. So if 4 years already expired on 1/4/2021, no notice can be issued now, as 4 years is between 3 to 10 years of clause B of 149. Yes, Namita, no notice can be issued. It could be 6 years, 4 years. Right now, if you see, the time limit is 3 years. Right now, the time limit is 3 years. So if the time limit of 3 years has expired, then no notice can be issued. Clear, Namita? Okay. Last one point before we close the session is Section 292BB. So if the assessee has appeared in any proceedings, say for example, the assessee has appeared in any proceedings and he has cooperated all the while. And even if, say for example, 148 notice is not correctly issued on him. So say for example, the assessing officer has not followed 148A and he has just issued 148. Notice he has not issued 148A order. And the assessee has appeared, he has cooperated in the entire assessment proceedings. He has not raised any objection at the start. So it shall be deemed that the notice served upon him has been correctly served on him in accordance with the provision of Act, and then that assessee will be precluded from raising any objection that the notice was not served on him properly or was not served on him in time. So if the assessee is cooperating in all the proceedings and he is not raising that objection at the start, he is precluded from taking that objection at later point in time. But if he has raised the objection before the completion of assessment, then he is not precluded. But if he has cooperated, he has given all the information, he has not taken that objection at the time of assessment, then he will be precluded at a later point in time during the appeal to take that particular objection. Is that clear? Any doubt? So we have done with the assessment proceedings chapter. In the next class, what we'll be dealing with is the appeals, which is tomorrow only. If you have any doubt, we can discuss. Otherwise, we can just close the session. Is that clear? Okay, so if there are no doubts, we can just close this session and we can meet. Okay, one doubt is the Namita. If the assessee raised the objection just before the assessment order is passed, yes, it will be valid. Before the assessment, that is all valid. Is that clear? Okay. So let's close the session. Thank you so much. See you tomorrow.